Hi, everyone. I'm just going to do a mini lecture for some of the material covered in week 7. We did cover an awful lot of it in the homework, so this is pretty brief. But the first example is on March 10th, Bob issues 1,000 shares of $8 par value common stock for $12 per share. How would the company journalize this transaction? So the cash is going to be the 1,000 shares at $12 per share, which is 12,000. We'll debit cash for the 12,000. Common stock is 1,000 shares at $8 per share, the par value, which is 8,000. We'll credit common stock for 8,000, and the paid in capital in excess of par common stock is the 1,000 shares times the $12 per share that it was sold for minus the $8 par value, which is $4. So we're going to go ahead and credit paid in capital in excess of par common stock for the 4,000. The next 3 items are just related to treasury stock. So on January 1st, stockholders' equity section of Bob has 300,000 shares authorized, 100,000 shares of $10 par value common stock outstanding. It was all issued at par value. Retained earnings of 400,000. On February 1st, Bob acquires 4,000 shares of its common stock at 12 per share. What's the journal entry to record the transaction? So we're going to debit treasury stock and credit cash for 48,000 because it's 4,000 shares times $12 per share. On July 1st, Bob sells for $14 per share, 1,000 of the 4,000 shares of its treasury stock previously acquired at 12 per share. So we're going to debit cash for the 1,000 shares times $14, which is 14,000. We're going to credit the treasury stock, which is 1,000 shares at $12. That's what it had been acquired for. So we'll go ahead and credit treasury stock for 12,000. And then the difference between the two, that 2,000, will be a credit to paid in capital from treasury stock. On July 8th, that example was when we sold the treasury stock for more than it was acquired for. The next example is going to be when we sell treasury stock for less than it was acquired for. So Bob sells for $11 per share, 1,000 of the 4,000 shares of treasury stock previously acquired at 12 per share. So the cash is going to be 1,000 shares at 11 per share. So we're debiting cash for 11,000. Treasury stock is the 1,000 shares at $12 per share. We're crediting treasury stock for 12,000. Then we're going to debit, in this case, the paid in capital from treasury stock for the difference between the 11 and 12,000, which is 1,000. I just want to point this out. I made a little T account, which looks a little strange, but if you look at this T account, this credit of 2,000 is from this July 1st transaction where we credited paid in capital from treasury stock for 2,000. The 1,000 is from the July 8th transaction where we debited paid in capital from treasury stock for 1,000. So it leaves us a balance of 1,000. I'm not going to do an example of it, but I just wanted to let you know if we were to continue, for example, issuing additional shares of this treasury stock we had acquired, if we were to keep issuing it for less than this $12 per share we had originally acquired it for, eventually we hit that $1,000 balance, anything after that $1,000, and because we no longer would have paid in capital from treasury stock, right? The balance would be zero. We would start to debit retained earnings for whatever that amount had been. Okay, next one. On January 1st, Bob had 30,000 shares of no par common stock issued and outstanding. Stock has a stated value of 10 per share. During the year, the following occurred. First, they issued 10,000 additional shares of common stock for 14 per share. So for that, we're going to debit cash for the 10,000 shares at 14 per share, which is 140,000. We're going to credit common stock for the 10,000 shares at that stated value, $10 per share. So we're crediting common stock for 100,000. And then for the paid in capital in excess of stated value common stock, that's going to be 10,000 shares. And we're going to take the $14 that it was issued for minus the 10 stated value, which would be $4 per share. So we're going to credit paid in capital in excess of stated value common stock for the $40,000. Other way to do it, we could have simply taken the 140,000, subtracted the 100,000, and that would leave us 40,000. May 10th, declared a cash dividend of 2 per share to stockholders of record on May 31st. So for this, we've actually declared this cash dividend. So to determine the number of shares, it's 30,000 plus 10,000. 30,000, which we initially had in the first question, plus we issued another 10,000 on February 1st. So that's if we add that 30,000 plus 10,000 together, that's 40,000 shares times 2 per share is 80,000. So we're going to debit cash dividends, credit dividends payable for that 80,000. So we've created a liability at this time. So at the declaration date, we actually have a liability. Now on June 10th, we're going to pay that $2 cash dividend. So we're going to debit dividends payable for 80,000, credit cash for 80,000. So this dividends payable is no longer a liability to us. We've actually gone ahead and issued the cash. Next, November 20th, issued 1,000 additional shares of common stock for $16 per share. So the cash for that is 1,000 shares times $16. So we're going to debit cash, 16,000. The common stock is 1,000 shares at the $10 stated value. We're going to go ahead and credit common stock for 10,000. And for our paid in capital in excess of the stated value common stock, we're going to take the 1,000 shares times $16 minus $10, which would be $6 per share. So we're going to credit paid in capital in excess of stated value common stock for the $6,000. We could have also backed into it. We could have done 16,000 minus 10,000 equals 6,000. Last item, December 15th, declared a cash dividend on outstanding shares of $2.50 per share to stockholders of record on December 31st. So at this time, the number of shares we have is the 30,000 that was in that initial information, plus the 10,000 shares issued February 1st, plus the 1,000 shares issued November 20th. So if we add that together, 30,000 plus 10,000 plus 1,000, that would be 41,000 shares, times $2.50 per share would be $102,500. So we're going to debit cash dividends, credit dividends payable for that $102,500. Again, at this point in time, it's a liability to the company. So that is all I wanted to talk about for week 7. Have a wonderful week, everybody. If you have any questions, please feel free to reach out to me. Bye, everybody.